Good morning and welcome back, everyone, to our Monday morning trade ideas research session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And last week we saw the S&P 500 and the NASDAQ 100 continue to set new records last week. However, I do think it's important to recognize that, we are at a point now where, could everyone hear me? I want to make sure. Okay, perfect. There's a couple of perfect. Okay. But I do think it's worth noting that, and we'll take a look at the charts here in a couple of minutes here, that on daily and weekly timeframes, this rally is just starting to reach what we would typically consider as overbought conditions. The daily has gotten there before, but the weekly, is starting to approach those levels here. And that's a sign that we need to start being a little bit more cautious in terms of this particular rally. We've seen a nearly 30% rally in the S&P 500 since the April lows. And it has, now we are approaching 90 days into the tariff pause. And we have to remember tariff is what originally sent us lower here in the S&P 500. And you really kind of have to ask yourself, 30% higher from those lows in 3 months. What does that mean for the overall markets? I think ask any way to measure the markets, things look, at least in the short run, a little bit overextended. We're starting to see some signs of exhaustion here to the upside. So when those two things are coupled with each other with, a week that is probably going to be largely dominated by headlines from trade deals. The question is, are we going to see a little bit of volatility this week? And I think that is, at the moment, going to be the base case with the VIX, hovering around that 17% level. You have multiple major trade deals that are sort of at the negotiation tables right now. And the markets are being awfully calm as a result of it. So I think these are some of the things that we need to largely be paying attention to. And, the thing to note here also on the economic side of things is last week's employment numbers, the headline number came out relatively strong, 141,000 jobs added on Thursday. But, we saw that almost half of that was government jobs. So private job growth was pretty low, especially if you look at the ADP numbers. We actually saw 33,000, negative 33,000 jobs added last month. So the private side of things, in terms of job report, was relatively on the weekend. And prior to that, we had some consumer confidence and consumer spending numbers coming in a little bit a week prior. So, economic data coming out here has been certainly on the softer side. We have the FOMC meeting coming up. So the question is, is the job market soft enough for the Fed to potentially look at lowering rates, which obviously would be a sort of a net positive for the overall markets. And the economic calendar this week is pretty light. The big thing is probably going to be the fact that we're kicking off earnings season again. At the end of this week, largely is kind of when we start seeing Delta reporting. Next week, we've got some of the banks reporting. So the markets are being awfully quiet, especially as we kind of reach these new all-time highs. But I think this is going to be the week that we have to keep our eyes peeled for potentially some volatility this week. So we'll take a look at kind of our top ideas here for this week here in a moment, but let's take a look at the overall charts here. The S&P 500 managed to make a new all-time high last week, basically just continue to make higher highs throughout the week. We're starting to see some signs of exhaustion here with momentum here to the downside. Not a huge amount of divergence, but some divergence nonetheless. NASDAQ 100 making new highs, starting to show some signs of a divergence. Not enough divergence, in my opinion, to be in any way, shape, or form concerned about the overall equity markets. But there are other things that we are looking at that are certainly a little bit slow, are slowing down a little bit. Equal weight S&P 500, the Russell 2000 still continuing to confirm new highs here, trying to make it back up to that 230 level here to the upside for the Russell 2000. And then the equal weight S&P 500 index, we've seen kind of the equal weight index breakout here above this 180, 182 level here. So we're looking for that continuation higher here. So we're continuing to see kind of we're continuing to see the rest of the market play a little bit of catch up here, and that generally has been a good sign here for the equity markets. And the question that we really have here right now is whether or not this rally continues to have legs as we make new highs. There's certainly a lot of positives going on here for the markets here right now. There's a lot of optimism. There's a lot of retail participation in the overall markets. But I do think we have to still be cognizant of the fact of where interest rates are, the fact that economic data is coming in a little bit softer over the last few months, especially employment numbers. And that is going to start weighing on some of the concerns that people have here for the overall markets. Bonds continue to signal a fairly strong, risk-on environment. We basically have a continuation higher for HYG, which are high-yield corporate bonds. So the bond market is not particularly concerned from a credit perspective and provides kind of the environment for a continuation higher here. But note that as we continue to make higher highs in HYG, we're starting to see some divergence here with momentum here as well, showing us that there is a higher risk of a bit of a short-term pullback here for bonds. And then if you look at TLT, we're also seeing a little bit of pullback here at the end of last week. Not enough. We saw the 10-year yield rise a little bit here towards the end of last week, but overall, we continue to see bonds on an upward trajectory here. And then looking at the ideas that we have here for the week, this week, the only thing that we've added here is Tesla here to the downside. So we'll take a look at kind of where we currently stand here with the trade ideas. At the moment, we have 6 bullish trade ideas and 5 bearish trade ideas. So a fairly balanced amount right now. We haven't added much to the bullish list in the last week or so as we kind of continue to make new highs because, again, the equity rally is at this moment looking more and more extended to the upside. It favors the risk reward favors more here to the downside at the moment. So Block was one of our more recent additions here. We kind of like the fact that Block seemingly has formed this bottoming formation and started to break out higher here. You can see a breakout here on multiple, broke out above $60 level, came back to retest this level of support and continuing to move on. Our upside target here for this is around $85, which is right around when it kind of gapped lower here. Back in February, we're looking for that kind of gap to fill into that $85 level here to the upside. And then when you look at the fundamentals here, Block, as you can see, trades a pretty significant discount to its industry. If you look at growth expectations, it far exceeds its industry average, and it is more profitable than its peers. So for those reasons, because it trades at such a significant discount, that's really where we expect that at the very least it would catch up to its industry average, which also would imply a significantly higher upside target than $85. Our $85 upside target at the moment is more of a technical based upside target. If we can get to 85, we do believe that there's further upside beyond that. But at least in the short run, our first upside target is 85. And if we can get there, we'll look at seeing how far we can get this to extend here to the upside because, as you can see, even earlier this year, the stock traded at 100 and we were long this particular stock back then, but we simply got out of that when the trend started to deteriorate here to the downside. But now we think it's time to get back in. Norfolk Southern railroad stock. We usually don't talk about railroad stocks at all, but this is a stock that's continued to improve and show kind of strength here to the upside. Looking at kind of the business, it's not particularly interesting. Trading basically in line with the industry. Growth expectations roughly in line with the industry. The only thing that Norfolk Southern really has going for it is the fact that net margins are so much higher than the transportation industry average. So for those reasons, this valuation, in my opinion, is on the low end. That in Norfolk Southern, they can easily be trading 23, 24 times forward earnings, which implies a significant amount of upside. And even then, our upside target right now at 275 is pretty conservative here. 275 is basically another $13, $12 here to the upside from where we are trading right now. Looking at Alphabet, Alphabet continues to kind of improve here. We basically took a long position here. When it pulled back here, we're looking for these pullbacks to look for continuations higher. Our upside target is 185. So we're very close to that 185 upside target. Once we get to 185, we'll reevaluate as to, what our upside targets beyond that look like. Because if you look at the business here, you do have this, and you also have this gap fill at 200, I'll call it 202, that remains unfilled. That would be a potentially upside target once we get to 185, looking beyond that. But if you look at the business, Google or Alphabet rather trades, basically in line with the industry, trading around 19 times forward earnings. Growth expectations very much in line with the industry, but where Alphabet exceeds significantly are its net margins. 30%, 31% net margins versus around 6% for the industry. So, because of how significantly more profitable it is, that's really what should justify, a multiple that trades well into the low 20s, probably closer to 24, 25 times forward earnings, in my opinion, would be reasonable, given kind of the growth expectations that we're expecting for Alphabet. And also just if you consider, Alphabet being one of the leading AI-themed investment opportunities, the fact that it only trades at 18 times forward earnings makes it one of the most one of the cheapest ways to get access or exposure to the AI theme within the media / software space. Almost every other competitor like Meta, Microsoft, even if you think about hardware, Oracle, Nvidia, trades well into the 20s and much closer to 30 times forward earnings in most of these instances versus, Alphabet's trading at under 20 times. So it makes it an interesting alternative, I would say, to some of the more obvious names within the AI theme. Target. This is one that we added here a couple of weeks ago. Basically, as you can see, the stock shed 50% of its value in just this previous year, but seemingly has put in a bit of a bottom here over the last 3 months, and just last week started to break out here to the upside. So we are looking at this, what looks like a completion of a bottoming formation as an opportunity to look at target here to the upside. Our upside target here is around 130 here, which is where we were trading at back in February of this year. And if you look at the business, trading at 14 times forward earnings is significantly lower than the industry. Yet, if you look at growth expectations, largely in line with the exception of revenue. And that's one thing that I do think, we do have to factor into that valuation. But if you look at net margins of 4%, that's higher than about 75% of its peers. So the fact that it's quite a bit more profitable than most retailers in the industry, revenue growth is definitely something that they've been struggling with, and that's part of why the stock has been trading at such a low valuation. And I don't know that they've solved that problem. They certainly are trying to solve that problem with e-commerce, with improving kind of their digital experience. But if we can see that revenue number improve, there are, Target has one of the strongest fundamentals within the retail space and should be trading at a much higher multiple. You look at Walmart. Walmart has higher revenue growth, but actually lower margins. And Walmart trades at 37 times forward earnings. Costco, very similar growth metrics to, are similar, more similar growth metrics to Target, lower margins, trading at 50 times forward earnings. So Target very much has the opportunity to trade at much higher multiples if they can fix their revenue problem right now. And I think that's their main focus. If they can get there, that's the upside potential that I see here. And the charts seemingly are showing that some investors are starting to pay attention and starting to potentially maybe accumulate some of those stocks. And I think now is an opportunity for those of you that are a little bit more speculative, looking for something new, looking for something that's not 52-week highs. Target's an interesting way to look at that. Schwab. We've liked Schwab basically as soon as it broke out here above this 52-week high. Traded all the way up just shy of 90, pulled back a little bit, and now it's trading back above 91. We're looking for that continuation higher here. Our upside target is 95. See, Schwab is trading at a small discount to the industry, but if you look at growth expectations and net margins, basically on all lines, it outperforms its industry. So the fact that it trades at a discount to its industry, leads me to believe that this should be at least trading at 24, 25 times forward earnings, which actually implies an upside higher than $95. But that's a more technical based upside target. And I think that we could probably trade, once we get to 95, we could easily get to 100. And that would put us closer to, 24 times forward earnings for Schwab. So worth paying attention to, just a company that is not on everyone's radar, but generates a good amount of profits, a significant amount of growth, yet trades at a very reasonable valuation. And then lastly, on our bullish list here is Micron. Micron, we basically liked it when it started to break out here above this $85 level here. But after consolidating for a little, it had a very strong run. Earnings recently came out, consolidated a little bit here. And I do think pullbacks here into that 115 level here are great buying opportunities. So we continue to remain long here in Micron. Our upside target is 135. So you can see it trades at only 10 times forward earnings, which I don't think it's fair to compare it to the overall semiconductor industry, which trades at 26 times forward earnings, but that's the closest that we have to compare it to. There isn't particularly a sub-industry for memory, but memory stocks generally don't trade at high multiples. They're just commoditized businesses, and they generally tend to trade at low multiples. They tend to also have low margins, or lower margins. And just highly competitive industries. But Micron's a little interesting because they've recently kind of retooled their business to focus on developing kind of high bandwidth memory chips for NVIDIA GPUs for AI. So it is an interesting alternative way to get exposure to the AI theme from a hardware perspective without investing in the most obvious players like NVIDIA or Oracle that are at this point, fairly crowded trades and trading at fairly, I would say, reasonable or fair value valuations at this point. Micron, I think, uh, somewhat fair value, but I don't think investors are really thinking about it as much as they are about NVIDIA from a GPU and from an AI perspective, trading at only 10 times forward earnings. I think that gives you a little bit of room to the upside, if things do kind of take off a little bit. Growth expectations are far exceed the industry and actually look like growth expectations that you see from companies like NVIDIA. Um, Net margins are nowhere there, right? NVIDIA's net margins are 55%. Micron's here are 18%, which are respectable margins, but just not, that doesn't hold a candle to NVIDIA. But NVIDIA also trades at 35 times forward earnings, versus Micron's trading at 10 times forward earnings. So it gives you, pretty significant upside or a significant amount of room for this to grow before it trades at what I would consider, a rich valuation. I think right now it trades at a very reasonable valuation considering the growth and how profitable it is. And, if Micron continues to focus more of its business on kind of call it niche memory, right? Specifically for AI use, there is some upside opportunity here that I think is not particularly obvious, or is not the obvious investment for AI. So the next stock that I wanted to cover, so that rounds out our bullish ideas here. Now, taking a look at some bearish ideas, the first one is the newest one that we added here, which is Tesla. Now, we added this before we found out Tesla was down roughly 6-7% pre-market this morning already. My thesis on Tesla is just the fact that the valuation is just out of this world. I don't know how else to explain it. Right? It's trading at 167 times forward earnings. There's very little to justify those types of valuations. The only thing that really works is, you assign a huge amount of value to its CEO, Elon Musk, who I have an extreme amount of respect for, and I believe that he truly is, someone who can deliver a ton of value for a company. But at the moment, in terms of my view of Tesla, in terms of its outlook, it's just not there. Not enough to justify a valuation, of 167 times forward earnings. We're talking about a valuation that's 15 times its peers. Yes, robotaxi is exciting, it's interesting, but there are a significant amount of competition within robotaxi, and Tesla is very much in the very early stages of that, and I think that it's going to be a slog. And I don't particularly think that it's going to be an easy business to dominate. So for those reasons, I think the fact that we're assigning such large valuations to nothing more than just, at this point, a big what if, I think there's a lot of downside risks. And I think investors are starting to see that here as well, even though, the retail participation and the retail mindset for this particular stock continues to kind of, what's the right word, befuddle any valuations that you could potentially put on this. But I think we have to be realistic about this. If you look at delivery expectations, it's already down 25% this year. They missed that. Yet the stock is kind of still continuing to hold these names, hold these valuations. net margins of 6%. Yes, it's pretty good for the industry, but overall, those are thin margins. Car companies generally operate on pretty thin margins, and we're continuing to see Tesla's margins continue to get hit over and over again. And that's where I see a pretty substantial downside risk here for Tesla. My downside target is here $180. That's pretty slow, that's pretty far from where we are right now, 315. And as you can see last week, with that 13% drop in Tesla, that's when our trend indicators turn red. And when we rallied back up to basically the gap lower here, that's when I said it's time to get short. And I think now is a good time to start seeking some bearish exposure here for Tesla. Cintas, this was a trade that we put out here last week. And this is one that we started to see the trend quality deteriorate here a little bit over the past past few weeks here. As you can see, the 1 month trend has started to turn negative here. Momentum has also turned negative here. Recently rejected at a 230 level here. Our downside target is around 185. Cintas is, they make uniforms. It's not particularly sexy. It's at 45 times forward earnings. This is really one of the areas in the market where I think there's quite a bit of excess. Look at growth expectations. These are not spectacular numbers. 11% EPS growth, 7% revenue growth, respectable, but nothing to write home about. Nothing to really, in my opinion, justify 45 times forward earnings. Especially when you look at net margins, 17% are solid margins. They're industry-leading margins, but do they justify 45 times forward earnings? You're talking about a multiple that's significantly higher than NVIDIA, significantly higher than Oracle. The numbers just don't add up, in my opinion. So for those reasons, I think Cintas, potentially some downside risks, especially if we see markets pull back a little bit. Walmart, this is one that we've continued to have a bearish view on. Basically, recently got rejected at $100 multiple times. And we're just looking for that potentially rolling over here as well. Our downside target is fairly conservative, the $91 downside target here. We're not looking for a lot of downside here, but, Walmart trades, like I said before, 37 times forward earnings, which is in contrast to target, right? If you look at growth expectations, look at these numbers. EPS growth, revenue growth, net margins, most of these numbers are actually lower than targets, with the exception of revenue growth. Revenue growth is 4% versus 2% for target. So, what makes Walmart that different from target in terms of a business? And that justifies trading at 37 times forward earnings versus 14 times for target. And I just don't think that there's enough of a difference between those two businesses that explain that big of a difference from a valuation perspective, which is why I like Target here to the upside, while at the same time I like Walmart here to the downside. And I would bucket Walmart and Costco sort of in the same bucket if you want to. Costco trades at 50 times forward earnings, which you could argue is even higher multiple than Walmart. But it's the same thing. The metrics for Walmart and Costco look almost identical, and they both trade at just insane valuations relative to a stock like Target. Now, Apple's an interesting one because it's rallied a little bit here over the last couple of weeks as it sort of explores, its AI partner. It's basically sort of admitted that they're not going to be doing AI in-house, and they're going to be exploring external partners with Perplexity and OpenAI. And I think for those reasons, I think the recent rally here into that 213, 214 level here on Apple is an interesting level to potentially get short. Trading at 27 times forward earnings, which is, again, getting up there here. And the only thing going forward is really just net margins of 24%. Growth expectations has come in substantially here this year. we've seen kind of both top and bottom line expectations come in. Analysts have revised those down significantly here in the last year or so. Net margin so far has held up, and that's the only thing justifying a 27 times forward earnings. But I've repeated this over and over again, week after week, my views on Apple, and they have just remained the same. They clearly have become they clearly are no longer a leader in the smartphone industry, especially when it comes to AI. And it's questionable as far as whether or not they will be a leader in the kind of the next phase of devices, whether that's augmented reality or not. Apple has staked a lot of investment and their future on augmented reality. And it's yet to be seen as to whether or not they will be the dominant player in that particular space just yet. So for those reasons, I think the valuation for Apple is hard to grab my arms around. I'm a prolific user of Apple devices, and I hope that they innovate and stay relevant and continue to be around because I love their devices, but the valuation that it currently trades at is one that I am not in love with. And I have maintained a bearish position here on Apple for quite some time as a result of that. And T-Mobile. We've been bearish on T-Mobile also here for a while now. And recently it rallied, and I think to a level that I also think from a risk to reward perspective looks potentially bearish. T-Mobile trades at 22 times forward earnings, which is substantially higher than the industry. And you could argue that because it's of its superior growth and slightly higher than average margins, that it should trade at a premium. And I think that's true. But to trade at a premium that's more than 100 times, 100% higher than the industry average is what is harder to justify. And I think for those reasons, we've seen T-Mobile underperform the market pretty significantly in the last 6 months. And that underperformance might continue, especially if we get a pullback here in equities, as kind of the economic data continues to come in a little bit softer than expected. So for those reasons, that is where we currently stand here for the broader markets. Now, earnings, not much going on this week. The only thing really I think worth paying attention to is Delta, just to kind of give us a sense for what early reports sort of look like. Delta, in terms of options, is not particularly one that I think is worth trading, but just be aware of that earnings announcement coming out this week. Next week, we will get a lot more opportunities to trade, and I'm looking forward to restarting our earnings navigator with earnings season kicking off in full gear next week. So with that covers what I wanted to share with you here today. I hope that this gives you a view of kind of where we currently stand from a macro perspective, because this equity rally is getting overextended. It's getting a little bit long. And the trades are pretty crowded right now. So just be aware of that, especially when volatility expectations are so low, given that we are going into a week that has a lot of potential for volatility with trade deals. So stay safe, and I hope you guys have a great trading day. Thank you so much, and I'll see you guys here later in the week.